Nobody talks about that though. I bet that's a better metric, right? I think.
Well, you hear sometimes the syndicators, oh, I own 10,000 units, and they're like a very small GP in one deal, and they put in like 50 grand, and they're like, yeah, I own 10,000 units. And then,
3, 2, 1.
All right, today we have Anthony Scantariado,
Wow.
co-founder and principal of Red Knight Properties. He's a local Jersey guy, but does not buy in Jersey.
I used to buy in Jersey.
You used to, and then he learned his lesson. He
We did really well in New Jersey,
Yeah?
I have to say. We still have properties here, but, you know, we're moving forward. We're in other states.
where it's a little more landlord friendly.
A little. How long does an eviction take in New Jersey right now?
Oh man, depends on what county. What county?
Average, what, 6 months?
6 months.
6 months, yeah.
Yeah.
It used to be a month and a half, 2 months, right? Ever since COVID, it's just
Yeah.
downhill.
What's it like right now for you? Where are you buying now?
We're in 6 different states. New Jersey being one of them. We
Mhm.
still have holdings here. Pennsylvania. We had a holding in New York State. We sold that. And you talk about even worse than New Jersey, landlord-tenant laws. Ohio, Florida, and Alabama.
Ohio, Florida, Alabama.
3-day pay or quit in Alabama.
Wow.
Yep. Sheriff's on the door in 2 weeks.
Get out of here.
Mm-hmm.
That's so great.
So it
That's so
definitely
great.
helps.
So
But
Is that your reason? Like you're like
you look at net migration trends, you look at, different economic indicators, where are the jobs, where are millennials moving to. We look at many different demographic indicators, just like I'm sure you guys do in your business. And we just think it makes a lot more sense from that standpoint. And as obviously the landlord-tenant laws help as well. Just, so we're staying on top of collections because collections, and I was just telling David before, we self-manage. So we're on top of our rental collections pretty much daily, if not hourly, to understand what the status is. And if you're invested in New Jersey and you haven't had a tenant pay for 3 months, there's really nothing you could do.
yeah.
Instead of, and just got to let the system play itself out.
So Anthony, you just give a brief background, everybody. You own about 1,000 doors.
Yeah,
right?
give or take.
You're a young guy, relatively speaking.
I don't know. It was my birthday last week.
Oh, happy
I
birthday!
feel old.
How
Wow.
old you
Yeah.
turn?
How old do you think?
I'm thinking.
I'm gonna go with 33.
No,
All right.
I'll go with 30, 31, 32.
All right. Took the under on that. 31.
There we go.
Yeah.
Nice.
Yeah.
Nice.
So young but incredibly successful. You got 1,000 doors under management. I'm sure it wasn't like that when you first got started. Obviously, can you just kind of walk me through your real estate
two
journey?
family.
We started with two
Started
family.
with it. Well, and I know David from my previous, I wouldn't say career, but I worked for another real estate operator from 2015 to 2020, buying multi-tenant Class A office buildings up and down the East Coast. It's based out of Morris County in New Jersey. So I worked there. We got to learn
Is
a
that
lot.
Hampshire? Is that you guys work together?
Vision.
No,
Oh,
Vision.
Oh, okay.
Vision. And had a great experience. Can't say enough positive things about the principal there and the team there. Learned a lot. Worked 80 hours plus a week.
That's right.
And, but on the side, I bought, a 2-family home, and I was like, wow, I'm making $1,000 a month and I don't have to do shit. So not, I did some value add in the beginning, but it was just kind of a light bulb that went off. And I was like, wow, let me see if we can, I could buy some more units on the side. I'm still young. I only have a few years in the business. And, let me see what else I can buy while I'm still here. And started out with 2-family house. I still own it today. And then there was a 2-family flip that I bought with the partner. We sold, did well on it. And then I bought a 10-unit with my partner. He's still my business partner, Brian Leonard, in northern New Jersey. We bought, basically, while I was working, we bought about 70 units together, mixed-use properties. So mostly in Morris and Sussex County. So, basically 25 to 50 miles northwest of, Midtown. So to speak. And they were in 4 different towns. There were a few different properties. They were like 10 unit, call it $1 million, right?
Yeah.
For each property. They're about 10 unit properties. and they were mostly from long-term owners. The broker was able to source all the deals for us, and they were mostly off market. One was on the market, but it was on Zillow. It was one of those listings where you had no idea what it was on Zillow.
Yeah.
It was actually an apartment building. Those are the best because they're completely mismarketed. And so we bought those together. We were able to turn them around. He did most of the management while I was, I still had a job. I still had responsibilities and duties. So, but my partner did most of the management, contributed capital. I contributed capital I could as well. And it was just a very simple partnership. And then late 2019 comes around. We found a 51 unit up in Sussex County. That it was like a $5 million deal. That was
What town?
In Newton.
I grew up in Hampton, which is the town over.
The town over. All right, so
Newton.
you know.
Where in Newton?
It was called. We rebranded it, but it was off of Mill Street.
I
off
know
of Route
exactly where.
206.
Yeah.
All right.
Yeah, I know exactly where. There's like a barber shop like next to it, or I think
across from
or maybe
it,
across.
Across there's a pizza place. There's like a
Yeah.
There's like a strip mall right across
Yep.
from it.
Yep.
I think one of them's a barber shop.
Yeah.
I don't know if it's still there.
Yeah.
But, we bought that in 2019. So that was our first syndication, quote unquote. And then I had another one that was off market that came to me from a different broker that was right behind. It was also in Newton, 64 unit building that I put under contract in December 2019. And I was like, wow, okay, now we got, 150, 180 units. I can't do both. I can't work there and that's not right to them, to my employer. And so, it was 25 at the time. I was just telling David, and I was like, why don't I just take I don't have kids. I'm not married. I mean, I'm married now, but no kids yet. Why don't I just, take the leap of faith now, because it's going to get a lot harder if I wait. But I did have units. I did have income coming in from the other properties, and we had a few case studies to, put ourselves in the right trajectory.
It's when you get started, right? I feel like there's 3 hurdles that every operator needs to overcome. It's capital, deal flow, and operations. Where were you struggling most when you tied that 50 unit up in Newton?
So we self-managed to this day, but that was when we self-managed. So meaning for the units that my partner and I acquired, the 70 units, we didn't have a maintenance technician on staff. We didn't have a property manager on staff. It was us. And we had vendors for plumbing, we had electrical, so on and so forth, renovations. So we just relied on them. But you can't do that with an apartment complex. You need some sort of staff.
Yeah.
So we were trying to do the same thing, that we did with our 10-unit property. It just didn't work. So actually him and I ended up going out to the property. I mean, where I live, it's only 40 minutes away in Morristown area, and same with him. So we were going up there pretty much every day for the first 3 months.
You moved in.
We moved in. I wish.
No.
I wish. It would have been a lot easier.
Yeah, right.
So we were up there pretty much every day. Like we were picking up the trash on the ground. The bears would get in the trash, so we, had to pick it up, make it. There's a lot of bears up there.
There's a lot of bears. Yeah.
And picking up the trash, making sure the laundry room is clean. We were knocking on tenants' doors that didn't respond to us in terms of collecting the rent, or they were month to month, and we were trying to get we're trying to increase the rents, and not just increase them, but we were doing renovations, outside renovations and interior. So we would literally knock on tenants' doors, and sometimes we do cash for keys. Sometimes we would do some negotiations on site. It's pretty crazy. But we learned pretty quickly that, from there, we can't do this. Like, there's no way we're going to grow. All right. So, obviously COVID happened in March of, 2020. So everything got a little wonky. Our second deal, that 64 unit we had under contract, the lending dried up at the time. So it ultimately closed, but it closed in July. So between that time period, we were able to figure out, okay, how can we manage this better? So we put some systems in place. We hired somebody to help us oversee each property on the management side, and then we hired a maintenance person full-time and a leasing person because, we were about to have some scale with 120 units in Newton. So we sold those properties in 2022, mid-2022, and I'm glad I did.
Yeah. How'd you guys do on those?
So we were able to complete the business plan relatively quickly on both of them within, I think it was like 14, 16 months. The average rent was, I think it was like $750 for like on average between 1 and 3 bedrooms. And when we sold them, they were $1,300. So we knew that going in. I think our basis was like a little less than 100 a door, maybe a little bit over. And then we sold them for, we refied in 21. So we had a 3.64% debt on it at 70% LTV
Wow.
for the new guy. So we were probably all in at like maybe 120 in terms of all in costs. And then we sold for 172.
Great.
And the buyer assumed the debt, 10,
Which
I
makes
think
it
it was
way more attractive.
7-year debt at
Yeah.
3.64. And I think we
Sick.
closed in September of 22. And that's when, everything was still increasing, and it's still increasing to this day in terms
Yeah.
of rates. So we did well on those two.
Amazing.
And I'm glad I did because, just realizing what was happening with because we couldn't evict anybody. There were tenants not paying, but we were still able to, got creative, and we're still able to increase the rents even, during COVID, and we're still able to finish the business plan. We just got really creative. We were really hands-on. It helps that it was local, because if it wasn't local, we, would have probably struggled a little bit more.
Right. I mean, how valuable is that experience, though? I mean, I feel like.
Yeah, I mean, invaluable.
Yeah.
That first, even we didn't buy another syndication until like towards the end of 2020, just because we wanted to get everything up and running. We didn't want to jump the gun into a new deal. So I think we bought another one. I think we closed on it in like November of 2020 was the next deal. That was in Pennsylvania, right over the border. So still somewhat local deal. We didn't really start buying out of state until 2021, like mid 2021. In Florida, where we started out with. So,
And what gave you the confidence? I mean, you guys are buying units. I guess you're already working in real estate. Your partner was doing what? Was he working another job, or he's?
He was actually an ex-NFL player. So he was retired at the time, and he was bored because he when I met him, he was 34. I think he's 39 now.
You meet a lot of NFL players in Morristown. Right?
Yeah,
'Cause
he got the Jets there. So he was, basically retired, but he was getting bored because, he just had a couple kids and he
right.
stay-at-home dad, he just was getting a little bit bored with that, even though it's a great experience. So we met and, like I said, bought those 70 together, and then now we're almost 1,000. But, like I said, we've sold quite a bit along the way. I think we've sold 400 units along the way. So our portfolio would have been a little bit more, but it's whatever, not complaining. Probably in terms of AUM now, probably 140 million if I had to guess.
That's kind of why I hate the AUM. I got, whatever, AUM.
Doesn't mean
And it's
anything.
like, well, it doesn't really matter, because if you sold a deal at the perfect time, but you lost the AUM, like, you still made a smart decision.
Yeah.
So people get tied to that AUM thing, and I think not necessarily always a good thing, right?
That's a good point. When you're talking about just experience, I mean, I just literally said, transacted, gone full cycle on probably 15 deals and across 1,500 units or 2,000, whatever it is. I haven't even done the math on that, but that's
Right.
probably what it comes out to.
Yeah.
Yeah.
Nobody talks about that, though. I bet that's like a better metric, right? I think.
Well, you hear sometimes the syndicators, I own 10,000 units, and they're like a GP and maybe like a very small GP in one deal, and they put in like 50 grand, and they're like, yeah, I own 10,000 units. And then there was one guy, I'm not going to say his name on here, but he misrepresented himself pretty significantly, and I haven't seen him close anything just because of what he was telling people. I think people sniffed him out.
Right.
So yeah, you got to be careful with what you say, but if you're truthful and you're honest, I mean,
Well, I think
you can back it up.
I think it's important for some of our listeners. A lot of them are experienced, but a lot of them aren't. And you hear these numbers tossed around, but you can technically own 100,000 units, but own 0.1% of 100,000 units.
Yeah,
And
exactly.
what does that mean?
It
right?
does not a
You
lot.
threw in $1 or something.
You threw in
LP.
$1, or you helped raise
Yeah.
50 grand for a $40 million deal, and like you have no idea about property management, you have no idea about financing, no idea about cost structure. You just So I've seen that.
Yeah.
And and it's funny, the people that start out that way, they're not in the business anymore. Like I went on actually the gentleman's website I'm referencing 2 days ago. I was like, I wonder what this guy's up to. Nothing.
Gone.
So yeah, it's gone basically.
Wow.
Yeah.
Wow. So and then as you're going through this, so ex-NFL player, he probably has some cash, but then you got to go raise money, I assume, right?
Yeah, the first deal we raised was like 1.4 million was the total, and that was including me and my partner. And I think he raised half, and it just kind of worked out that way. It was like he raised half, I raised half. Mine was mostly from friends and family and professional network. And I think his was too. We didn't have any NFL players coming in. We don't really have a lot of NFL players involved with us. We have a couple, but it's not as many as you would think. It's mostly professional, greater network.
Interesting. We had a guy, Max Lepp. He's with Max Management. He represents a bunch of NFL players, and we were tossing around the idea of, it seems like a lot of these guys want to get into real estate and don't know where to start. And we were speaking to a couple guys about potentially investing in some of our deals and maybe putting together an event with some there's a lot. I feel like there's a lot of synergies there. These guys, they want to be involved, right? Or they want to, get into real estate because it's safe. And
yeah. I mean, I think the stats are 80 or 90% of them go broke within 4 years after the NFL.
Right.
And it's pretty terrible. And so, obviously my partner was the NFL player, so he can speak to that a little bit more. But from what he's described is that the NFL does put you in touch with the financial advisor, but not all financial advisors have your best interest at heart, and some of them, advise stupid decisions, or the NFL player just says, "To hell with you, I know how to make my own decisions," and they blow it all in a year or two.
Yeah.
So it's definitely a mission. I wouldn't say of mine to help more athletes get be better fiduciaries. It's more of my partners, but it's definitely something that's on our forefront.
Yeah. And then, okay, so then you're in New Jersey. You're in Newton, New Jersey, which is not the worst place ever, but it's kind of like Alabama of New Jersey. If you
it is. Yeah, you can
right?
say that.
And then you jumped to Alabama. What made you do that jump?
Yeah, so we were successful on those two deals in Newton, New Jersey, and we bought 2 buildings in Pennsylvania as well that we sold as well. The same type of story, 100 or I think we sold for about 175. Very similar story. And we owned in Florida. I was exposed to Florida when I worked at Vision, my old employer, and I was exposed to the specific market where we bought. We bought in Clearwater and Tampa, greater Tampa Bay area.
Nice area.
So I was very comfortable with the market. Like I kind of knew a lot about it already. So we started to have success there too. And I was like, all right, well, what other states can we grow into? And we bought in Cincinnati, Ohio. We still own the property. We're almost done with our value add. And Alabama we got into in January of this year. So very significant progress there already. So it's only been 7 months since we've owned those properties, but we're doing pretty well so far. So moving forward right now, obviously capital markets are still nutty, and we don't really know where things are going. I kind of do, and you kind of don't, right? You think you do, but then there's a fake out. So we're being pretty cautious right now in terms of new opportunities. And we're working on a couple right now, but they're in markets we already own, and we know what the rents are and have management control. So I think that's for us moving forward what we're working on right now.
What's it like jumping into a new market as far as sourcing deals? Obviously, here in New Jersey, 45 minutes away, you could actually go knock on doors and implement the value add. But in a brand new market where you might not own assets, or you're not vertically integrated or have economies, like what are the difficulties that you experience, and how did you overcome them?
Yeah, again, it's the management, and it's really about trust. It comes down to trusting who you hire at the end of the day. And we had some really good maintenance technicians. We had some really good contractors, really good leasing agents. We sold that property in Clearwater, by the way. So we don't own there anymore, but we still own in Florida, Orlando and Ocala. But, it's really, you're on the ground, people are going to make or break you.
Yeah.
And, we do visits to the properties ourselves. We still went there. It just wasn't daily, or it wasn't monthly. Maybe it was bi-monthly or once every quarter, because we would go more. My saying is, if things aren't, like, we would be there if things aren't going well. Like, if things are moving, and if units are getting done, leases are getting signed, everything's moving in the right direction to our business plan, why do I need to go? If things are slow and you have a lot of vacancies at one time, and it's like, what's going on? The maintenance people aren't showing up. We've had that happen before. Then we go right away.
Right.
And we take action to implement different hiring procedures, or like we're not going to wait, to have we like to give, when we take over a new property in out of state, usually there's management that's in place, and sometimes we hire them. We say, hey, we have a property management company as well. We interview them, make sure that they fit with us, and they do well in the interview, but then when you close, they're like stuck in their own ways. They won't get on our property management software. They won't drop off notices to the tenants that we're the new landlord. They won't tell the tenants how to pay online, So you learn really quick. So, once we realize we're good people. We're not going to just, to hell with you, we're going to change management already. We usually give people, a pretty decent chance to turn things around. If it's not working out, we're going to make a change. So that's the hardest thing, just making sure you have trust in your, on the ground managers there. And if that requires, more airplane visits, we usually do day trips. So like we'll get on a 6 a.m. flight and I'll hit my pillow at probably 11:30 p.m., on the same day and in all the markets. So if we can get there within the day, we do what we need to do, then we're going to buy. If it's a flight where, we got to take 2 planes to get there, and, it's out there on the West Coast, I don't think we're going to be interested in it, just because things could go wrong, very quickly, and you got to be able to
get up there
to go.
Yeah.
Yeah. So
That's interesting. So it's all about hiring the right people. So before you close on a property, are you like how do you know what people you're going to hire? Do you kind of start building out a team before you even close?
yeah, we try to if we can. Like I said, a lot of the times the management comes on with us, but it's just they never. 9 times out of 10, it doesn't work out.
Right.
So we have, we use Indeed, we use different hiring sites, Facebook. So we have different ways to get talent. So we try to do that in advance if there's no management in place. I think we've done that a couple times, and usually we close, or we tell them we're going to close, and they'll have a job. We might not have somebody for 2 weeks after we close, but we'll have somebody start right away after then. So we've always been able to find talent. Whether the talent is good or not, you find out pretty quickly.
Right.
But in terms of the markets where we're in, obviously Florida's very hot and humid. Alabama's very hot and humid. Ohio can be the same as well. Someone that knows HVAC, someone that's certified to buy Freon. That's something I learned today. You need a certification in Alabama to buy that, like a separate one. So, making sure that our technicians are competent, and we're going to pay pretty well. We always, if we're in a property where we're going to refi or sell, we always tell, our maintenance and leasing agents or managers, hey, we take care of you. Like if you do a good job, we're going to take care of you. Sometimes, our property managers are getting a $10,000 bonus at the end of the year, or at a refi or sale.
Right.
That's a lot of money for some people that are in a certain income bracket.
Well, that's a lot of money for me.
A lot of money for me too.
I'd take 10 grand right now.
Yeah. So,
Definitely. I mean, 1,500 units. I'm sure at this point you have some horror stories. Give us one.
The one I always remember is just on the management side in the beginning with Newton.
Mm-hmm.
There's one tenant, and I remember her name. I remember what she looked like. We had to. What's great? The crazy thing about it is we evicted her. We started the eviction. Actually, we evicted her before COVID. It was very quick. It used to be very quick, and she ended up moving to the apartment building that we were under contract for. So I was like, all right. I saw her on the rent roll for the new building. I'm like, she's not going to pay. So just discount that off the cash flow analysis. But when we evicted her, she was giving us a hard time. I'm not going to get into some of the stories before then, but when we evicted her, we went into her apartment because me and Brian were checking. These tenants would leave. We would go up and see what the condition of the unit. We didn't have anybody. So we were checking out, this needs new flooring, or this needs new appliances, or, we can get away with painting the cabinets, instead of replacing them or doing new hardware. So this one tenant, I saw there was some artwork in the living room, and it was all over the place. There were people. And I was looking at it close. I'm like, this guy's shorter. This guy's taller. They both have nooses around their necks. And there's both profanity in front of it. I'm going to find you, F Anthony and Brian. I was like, oh shit.
Oh, it was you.
Yeah, it was us.
No way.
Yeah. So, the cops didn't do anything about it, but what are you gonna do,
Yeah,
right?
yeah.
So
It's a little scary.
yeah, so I walked into a unit and there was a drawing with a noose around my neck and my partner.
That is scary.
Yeah,
That is scary.
so that was interesting.
I think everybody has those stories. Everybody has at least one of those.
And I don't know what her problem was with us.
Yeah.
I really, because she didn't pay, so we evicted her right away. What are we supposed to do?
Right. I got the worst that happened to me is I got shit socked. So we had we had a tenant that we had to eject. They lost the house in foreclosure and then they stayed there. And we went through, it was during COVID, whole process. Finally, they get out, open the door. I walk, step in, and I step on it. It looks like a sock, and it's like squishes.
Ugh.
It was a shit sock. They shit, and it was like it was a booby trap. They trapped me, and they got shit socked. So, you know.
Yeah, that's, thank you very much.
Yeah,
That's-
thanks. That one stuck with me for a little while.
We had one, I've seen, more sad stories. I've walked into units where pills are all over the place.
Yeah.
That's more sad.
Yeah.
But I've walked into units with shit all over the place too.
Yeah.
With people living there.
It's crazy.
Yeah. I don't know how some people live,
It's crazy.
but we try to clean up the place from what they were before, and get better clientele, or even if it's the clientele that are there. Listen, you don't have to live like this anymore. We're coming in and changing things around. We try to do the right thing, but some people don't,
right.
don't want to hear that. They just want the cheapest place possible. And it's like, all right, this might not be the place for you then.
Right.
Go somewhere else.
What does your team look like right now?
Yeah. So in terms of the general partnership, it's me and my partner Brian, the two of us. And it's really property management. That's our team. It's really the two of us: underwriting, deal sourcing, kind of overseeing the management, overseeing the construction. It's really the two of us. So we're up to our eyeballs pretty much every day.
I was gonna say,
yeah,
you guys must be going crazy. How do you even have time to do a podcast right now?
It's a good question. Long story. I'll tell you after. But really, the bulk of the time is the management.
Yeah.
Quite honestly, we have a bookkeeper on staff. We have a senior property manager who oversees all the maintenance people on each site, or the leasing people. Sometimes the contractors, we get involved in that, a little bit more than what we should. And she has an assistant now, so we have enough units to kind of afford that. She has an assistant, so he helps her with lease renewals and move-ins and move-out schedules and collections. So we do have. I'm not doing that every day anymore.
Right.
I do look at it every day, but the bookkeeper, we have an outsourced tax return accountant. So we do have a team. In terms of the property management, it's more. I think it's like 12 employees we have, and that's leasing agents, and that's maintenance technicians and project managers,
and that's everywhere.
That's really location specific. Yeah, really, who's working for us is our senior property manager, our bookkeeper, and our assistant senior property manager.
Got it.
Yeah, and they're all remote. We don't have anybody in person. Our senior property manager is out of Missouri, and our assistant property manager is more of a virtual system. He's really good too. He's actually out of Pakistan.
Mm-hmm.
Yeah, so it's pretty
Nice.
interesting how you can, spread labor out, and
yeah.
it's really interesting how we're doing that. And our bookkeeper is actually out of India.
No way.
Yep.
Wow. So you're managing everything from afar, essentially.
Yeah. Yeah. Afar but close, right?
Yeah,
Because
close enough.
it's like,
doesn't matter.
I know probably, like, if you ask me about a property, I probably know way too much about it. But, if I wanted to know what was going on at the property, I just got to pull up my laptop and pull up our property management software and just click on the property, see what's going on. And all our communications are, through Microsoft Teams, our work order systems through the property management software. We have, most of our deals are with, syndicated, so we have equity investors usually putting in 50, 100,000, 200,000. So we have a portal for that as well. That's more through a third-party software subscription agreement.
Yep.
So we have a portal on that as well. But obviously, the investor relations are me and my partner, and the asset management, the reporting, that's still us. So it's a lot. But, to what I was saying before, we've sold a decent amount, and we have active syndications. I think we have maybe 1, 2, 3, 5 or 6 right now, maybe, that are still in the value add or almost done with the value add. But we had a lot more. I mean, like I said, we sold, I think 5 or 6, maybe 7. We're under contract to sell another one.
Nice.
So, we've been kind of in and out much quicker than I thought on some of these deals. I mean, we're always looking at 5-year holding periods. I'm sure, you guys do too. But some of these are just like, wow, it's happening in like 18 months. It's like crazy,
You can only do that in red states, really.
We did it in New Jersey, which is a blue state, in a red area in a blue state.
Yep. Okay.
But I mean, we don't. I mean, that factors a little bit into our decision making, where we're looking and whatnot, a little bit. But it's mostly suburban, 1 to 2 story garden style, walk up, 1970s to 1990s, class C. We would try to turn to C plus, B minus, complexes that are owned from long-term owners, between 5 and 20 million. Middle market, so we're not competing with the big guys, not competing with really small guys. That's a nice little niche that we have here. Our average deal size is maybe 7 to 10 million, on a transaction base.
Yep.
And when we go into a new market, we're looking at least 100 units just because we have the management component and we have to have, costs associated with that and economies of scale associated with that. So that's another thing when we look at a state. It's like, all right, well, do we have enough units to afford full-time maintenance and a full-time manager? So that's probably number one thing that we look at. Oh, how many units is it? Oh, it's in Kansas City. I like Kansas City, right? Oh, how many units is it? Oh, it's 30 units. Okay, I'm not going to look at that. Like,
because you can't.
I'm not going to, I can't have I can third-party manage it, but I'm just not used to. I'm not. At some point, I'll let go, but right now, I'm still want control. Just have control while you're young.
That makes sense. And you can
I
still
guess
do
I'm
it.
not young anymore. Yeah, you can still do it. Yeah.
So it sounds like you were buying deals in COVID and I guess a little bit after COVID.
Yep.
When interest rates were super low.
Mm-hmm.
And I'm curious, how many of those deals where you model them out, at probably lower interest rates than it is now, did any of those deals for you, did they not tie out, or you just bought, you bought so well that, it all kind of worked out for you? What?
Yeah, I mean, we never really. I was learned to be, in terms of the underwriting approach, pretty conservative for working at Vision. I mean, we were buying office. You have to be conservative.
Yeah, how are they doing? Are they?
Good. I have to catch up with them, but I heard pretty decent. The properties we bought even when I was there were, trophy and well located and had amenities. So that's what's doing well right now with office.
Makes sense.
But I learned to be very conservative in the approach, and when we like the 2 deals in Newton, that was before COVID. Right. Rates were still 5, 4.5, 5. Yeah. So like I didn't underwrite selling at. I think we sold at a 5.25. I underwrote selling at a 7.
Wow.
And the deal still penciled out. So like it was just that's what I was used to, right? So I mean, even when we bought during COVID, I was like, there's no way this is going to last for another year. Like these lower, there's just no way. So I always like if it made sense and I was selling at 400 basis point higher cap rate or expanded cap rate expansion, and it made sense, I'm going to buy it. And that's what I did. I mean, I still bought 6 caps during COVID, like actual tax adjusted, insurance adjusted 6 caps.
Right.
And now I'm glad I did because, people are, it's kind of like the minimum again. I'm not going to look at it if it's income producing at least at a 6 cap because that's just the reality of the market right now. So, and that's what I was used to. I mean, in office, we were buying, maybe 80% occupied buildings. Some of them were 10 caps. Like I was just used to that. So, I understand multifamily is a lot lower, and that's due to the risk premium of the asset. Is a little bit much more highly sought out after than office right now, at least. So it just kind of was just gravy to answer your question that we were able to sell these at lower cap rates than we thought. But we would have been okay if they were higher too. Right. Like if we sold them now, we still would have been fine.
Yeah, I mean that's great that you had that experience because I mean how many people were underwriting thinking everything's gonna stay
4.5 cap for Class C in Houston. I mean we could talk about that deal all day.
Right. Yeah, I actually wanted to ask you about you're seeing now all over the news, the real deal, all these things, syndicators going bust. I don't know if it's just one deal or just,
Yeah.
it seems like it was just one deal, but it's everywhere.
Yeah, it's gonna happen more. That's for sure. That was the highlight because that was a big deal. I don't know. I know probably more than most about the deal, but I don't know how they got that done. I really have no idea. On the debt and the equity side, I think they lost $100 million in equity, and then the lender took a 20% haircut. It's terrible, and that was in 8 months.
It's insane.
But I've seen stuff like that before, not necessarily with Vision, but I've heard stories like that. And, my father's also in the business too. He's a CFO for another real estate company. He's been doing this for 40 years. So it's good to have him on my side to, bounce different, ideas, and he bounces like, okay, well, we're in a different economic cycle, and like, this is what happened last time. And, even the principal at Vision, he worked at Goldman Sachs back in the 80s. He helped start the Whitehall funds. And that was, he just sitting next to him and just kind of, he's been through '08, he's been through '01, he's been through the 90s. It's just like, you gotta, not everything, when we were in 2020, 2021, the Fed's never going to raise rates ever again. Inflation's not going to get out of control. I'm like, what are you talking about? Like, I see it happening. Like, it's just like, you don't see that this is not, this is temporary. This is not going to be forever. And this is exactly what's happening now, playing out.
Yeah.
So when you're buying deals now, how are you modeling? Are you modeling for like a 200, 300 basis point expansion on the cap rate? What kind of rates are you modeling?
Yeah.
For refi?
It depends on the deal, depends on the market. We're definitely underwriting expansion, no compression, that's for sure. And I've always been that way. It really depends. Like, we just picked up in Alabama a 7.6 on in place cap.
Oh, wow.
Yeah, 106 units, kind of off market, unique situation. So I think I underwrote maybe 8 or 8.25 on my base case on that, then on an exit. Just, that was a little lower cap rate expansion just because we bought it so high on the cap rate. But yeah, I would say 200 to 400 at least. But it depends on the story. Like, it depends on, how low the rents are. If there's a really good story, if it's a, 10 plus year owner that just never touched anything. And okay, let's say it is a 5.5 cap. Okay, fine. On in place. Okay. What's the upside in the rents? Like, real upside, like what's the value there? Is it a good basis to begin with? And then what's my yield on cost? If my yield on cost is north of 8%, I think hopefully we're going to be okay. So that's another metric I look at as well. And that's, for like, we always do 3 different projections: downside, base case, optimistic. So I always refer to our base case, projections as, okay, my yield to cost is 8. I think I'll be all right. And, we try not to go too crazy with the rental assumptions either. We just kind of do it based on, at least if it's an asset we're buying in a market we already know, we just kind of mark it up to what we're getting already.
Right.
So we're not going too crazy.
Got it. Where do you think rates are going to land?
Are you talking short term or long term?
I guess over the next 2 years.
Yeah. So I haven't. I'm trying not to check because it's driving me crazy.
Yeah.
The 10-year note. I think we're probably at 4, if I had to guess, as we're recording this.
I think it was like 4.1.
It went up to 4.1. Well, we
Yeah.
had a strong jobs report. That's why.
Yeah.
So it's probably gonna 4 to 4.25, if I had to guess, hover around.
Yeah.
Which would put rates. I hate to say it, but 6.5, 7 right now on 5 to 10 year money. You can get better, with the agencies, with maintenance prepayment structures or step down prepays. I know for the agencies, Fannie's quoting they had the lowest spreads right now, from what I understand, like 180, which is pretty standard, like traditional norms. So 180 over, right now, 5.8, you can still get in the high 5s. But you realize you're taking long-term money. You're not really going to touch that deal for 10 years.
Mm-hmm.
And I don't know. It's kind of an interesting situation because that interest rate might not be the same in 2 years from now. And if you want to sell the building, someone's going to look at that debt and be like, dude, I can get 4.75. Like, why would I take your debt? I saw this happen when I was at Vision. So trying to, learn from the past. And it's like, well, why would I take the above market debt? I'm going to discount, the purchase price on this. So I've seen that it kind of reverse both ways. So we every time we're taking debt out, we look for flexibility if we can, even if it's a little bit higher rate. We always want the flexibility, just in case something happens.
Well, we were learning about HUD loans. What Harrison was telling us, which is basically, a little harder to get into, apparently.
A lot harder,
but people do it for sure.
Yeah.
And it's kind of a protection against interest rate decreases because how does he explain? Basically, they can.
You can loan modify, but it readjusts the amortization. So, like, if you get a HUD loan and you're 3 years in to a 10-year term, and rates drop, 2%. Rates drop like 2%. You could do a loan modification, take that, current prevailing market interest rates, but the loan readjusts back to a 10-year, as if you're starting in year one in the 10-year am.
That's interesting.
Yeah. And apparently they do a ton of them. They're like the HUD, these guys.
Oh, I'll look into that now.
But that way, if rates go down, you're good. But if rates go up, whatever, it doesn't matter.
And those are assumable loans.
Yep.
So
it says it takes about 6 months process.
Yeah, 6 months.
It's not really any more documentation or anything than Fannie Freddie, apparently.
Okay.
Just a longer process.
I'm not gonna lie to you. I have no HUD experience, so I have no idea. But that's interesting. But where do I think rates go from here? I was on the camp. We're recording this before the July Fed meeting. I was in the camp that they were all barking no bite, that they were going to pause for July. I'm thinking they're going to raise in July because of the jobs, and it depends. CPI is coming out next week. I mean, it could have a 3 on it. Yeah. It could even have a high 2 on it. I mean, so I don't know, but I think we'll probably get one more. If we'll get 2, that's debatable. And then I think we'll probably see a slow trickle down. Pretty much as soon as the lending market, the banks know that the Fed is done, that's when we'll see the spreads start to come in. Because, right now, besides the Fannie product that I'm aware of, even like the local banks, they're still quoting 300 over, whatever the Treasury is, which is ridiculous. Yeah. Historical norms are 160 to 180.
Yep.
So I think you'll start to see the spreads come in just once we know they're done. That's it. So that might take another couple months for them to be done, or just to proclaim they're done. But I do see a slow trickle down in the bonds in the 10 years. I mean, I'm not an expert, but that's just what I see. But I think we'll probably. I don't think we're gonna get a cut until. I don't even know if we'll get one in March of next year. Maybe whatever the next meeting is. I don't know. All depends upon economic data. It could get pretty weak soon. But we'll wait and see what happens. And it's kind of, you got to watch it as a real estate investor what's going on. But instead of I feel like I'm a trader because I'm like watching it every day now. I was like, I got into real estate not to have to worry about this all the time. But most of our portfolio was fixed rate. I would say our average rate is maybe high 4s or in the 5s if I had to blend it out, weighted average across our portfolio. And our maturities aren't, at least we have a couple that are due in 24, like late 24, but we're done with those in terms of the plan. And but most of ours are 5+ years out right now.
Nice. So 1,500 units and transactions. You're around 1,000 now. What's next for you? Where are you headed?
Yeah, like I was saying before, we have a couple new deals we're working on right now. So we're trying to figure out those that'll close this year, and then we'll see where we are, because they're probably going to close towards Q3-ish. Well, let's see where we're at. See where rates are at, see where the economy's at, kind of see where the rest of our portfolio's at. Just take a step back. I feel like it's been go, 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 go. It's good to take a step back every once in a while. So we're kind of because we don't have a fund, so every deal is deal by deal.
Right.
So that's how I think. I just think upon project by project and property by property, entity by entity. So I'm more of like, okay, we finished this, now we can move on to the next one.
Right.
But we'll see. It'll be an interesting next 6 months, that's for sure. At least to see how things play out.
So Anthony, I mean, we appreciate you, man. This has been an awesome time. Where for people trying to find you, whether they want to invest with you or ask for advice, work for you?
Yeah.
Where can people find you?
Yeah, so we obviously our website, redknightproperties.com. That's Red Knight with the K. We give out a special report. Basically, you put your name in, put your email in. I'll send it to you, and then that way you'll have my contact information. You'll get the special report. Just explains kind of a little bit more in detail what we do, how I was able to leave a full-time job and do this, and kind of my story and my partner's story. So you'll get that. It'll have my Facebook, Twitter, Instagram, LinkedIn link there. We have a podcast as well. I think you guys are scheduled to come on, called Discovering Multifamily. 20 to 30 minute podcasts, maybe a little bit longer with you guys, but and those get released. I think we're at 250 episodes right now. So we're continuing that, so you can listen to our show there as well.
Amazing. We appreciate you, brother. It's been awesome. Super
Appreciate you having me.
Thank you so much for coming on.